My name is Myooran Mahaligam, Portfolio Manager of Global Equities at MLC, and it's my very great pleasure to introduce Simon Blanchflower from Altrinsic Global Advisers. Welcome, Simon.
Thanks for having me here.
Tell us a bit more about Altrinsic Global Advisers.
Well, Altrinsic Global Advisers is a value manager. We search the world trying to find a handful of high conviction ideas. We're address agnostic, so we don't mind if that's developed world or emerging markets. Importantly for us, when we look at those ideas, we look at them as if we're owners of the business, as if we're going to buy them outright with our own capital. The other feature of Altrinsic being value is we need to find ideas that trade at a discount to their intrinsic value. And importantly for us, we invest right across the value spectrum, so a very flexible approach.
This is a firm that's been established since 2000?
Yeah, 2000's established by John Hock, now a 17-year track record.
And in investing in global equities, what are some considerations Australian investors need to take into account when going global?
Yeah, look, I guess the key ones are diversification and opportunity. Diversification in that you avoid the sector concentrations in Australia between banks and resources. There's quite high concentrations there, so by going global, you've got a much greater chance to diversify away from that, across multiple economies, countries, etc., different sectors. And also the opportunity set, simply. In Australia, you're looking at hundreds of companies, whereas when you go globally, you're looking at thousands of different opportunities, so a completely different scale.
And of course, you get access to companies like Amazon and Apple and Samsung. Those types of businesses you cannot get access to here.
Yeah, there's a lot more access, availability offshore, much more variety.
And currency is often a consideration for investors going global. Can you talk us through how you view currency?
Yes, of course. So obviously when you invest globally, you invest a new risk, which you didn't experience just investing domestically, and that's currency risk. The key thing with currency risk is to invest for the long term. The Australian dollar is a cyclical currency, so there are times when, particularly in the short term, where the impact could be quite positive or quite negative in terms of the return experience. But longer term, it tends to have less of an impact, and it can be a diversifier to risk as well.
And you talked about domestic equities earlier on. Can you talk through the impact China has had on domestic equities?
Well, it's been quite large, in fact huge, certainly in the earlier part of the 21st century. As China's became an urbanised economy, the demand for resources was very large, and that was a significant tailwind for the market from the early 2000s through to 2008. Now it's less potent, simply because China growth has slowed down a bit. There's still demand, but it's slowed down. And going forward, whilst we expect to continue demand from Australian resources, it's going to be from a much higher base. The point was it was a much lower base before. So no doubt still an impact, but perhaps not as potent as it was in the earlier part of the 21st century.
And Simon, you recently returned overseas from Japan. Can you share any thoughts from your trip overseas?
Well, Japan was interesting. I think saw quite a few companies over there. It's a space that a lot of value managers are attracted to because from a valuations perspective it does look cheap. The question is it undervalued? So we spent a lot of time visiting companies. The key thing for Japan though really will be next year to see whether if negative interest rate policy is removed, because that is something that has had a negative impact on sentiment in Japan, so it's quite important to see that removed. But nevertheless, valuations we still find are quite compelling, and also quite attractive asymmetry as well in terms of upside potential relative to downside risk.
And where are you finding opportunities today, globally?
Well, we're mainly, so we're bottom up, so we're not top down, so it's very company specific. I guess where we're spending most time is trying to find ideas, particularly that are uncorrelated with each other, quite idiosyncratic, very company-specific ideas, especially with market valuations being quite elevated. That's quite important to make sure you've got company-specific drivers. But we've been, from a top-down perspective, we've been underweight the US for quite some time, overweight Europe, overweight Japan. We've built a reasonable position in financials over the last year or so, but that's quite outside Western banks, for example. So again, that's quite differentiated from the market. And the other area I guess we've been building a bit lately is on the healthcare side, because the healthcare sector, whenever you go through an election cycle, often comes under pressure and can represent some value. So we've been buying a bit in that area as well.
Is there a stock that particularly excites you?
Yeah, I think at the moment one of the interesting pieces of news that came through in recent history was with Nestle. It's one of our larger holdings and a holding we've held for quite some time. They've brought in a new CEO, and it's the first time they've had a CEO external to the company since 1922. So it's quite a significant shift in culture. Nestle has sort of experienced subpar growth in recent years, and I think this is an opportunity for a fresh blood to come into the organisation, revamp some of the business units within Nestle and look to recreate growth opportunities. And not only that, but also to restructure costs and make the organisation more efficient. So we see that as quite a significant going forward opportunity for Nestle.
And you mentioned you're a global value manager. Value as a style has been under pressure if you look back the last 5 to 7 years. Any thoughts on whether you think that headwind will become a tailwind going forward?
Yeah, well, that's depending on what parameters you look at. That growth cycle looks like it's been in place now for almost 10 years. So it's been a big headwind for value managers. I think that if you think about where markets are today, they're quite elevated. You can obviously dispute how much, but I think margin of safety is going to become increasingly important, particularly if volatility normalises, which it should. The other aspect to that, of course, is whether the interest rate cycle has bottomed as well, because if interest rates start to rise, that will put more pressure on markets and create more volatility. So there should be more opportunities for value moving forward, particularly if this cycle starts to change.
Simon Blanchflower, thank you very much indeed for your time.
Thank you for having me, Myooran.